Hey guys, welcome back to the channel. Today we're going to be talking about investing, specifically the stock market, and why you should be investing and how can this increase your wealth and personal finance. Stay tuned. Today we're going to be talking about investing in the stock market. Basically, why do you want to invest in stocks? Your money works for you. When you buy a stock, you're buying the ownership, pieces of a company. If those companies grow and make more profits, your shares become more valuable. You are no longer trading just your time for money. You're also getting assets generating returns in the background. Historically, strong long-term returns. That's what stocks do. Historically, they have been going up over a long period. Stock markets have a tendency to outperform savings accounts, bonds, and even inflation. That's why people use it for big goals like retirement. It gives you a chance to compound. Now that's the key. What is compounding? Compounding is something that is very powerful. Returns build on themselves. For example, earnings 8% per year doesn't just add up, it snowballs. Over decades, that turns into small, consistent investments that grow into a large amount. You protect against inflation. Cash loses purchasing power over time. All governments print money, guys. Stocks, because they represent a business that raises prices and grows, these tend to keep up with inflation. And you can always, like I always say, start small and scale up. You don't need to be rich to invest. With modern apps we have today, a small amount can go a long way. So what are stocks? Stocks are simply ownership shares in a company. When you buy a stock, you're buying a small piece of it. Think Apple, Tesla, Amazon, GM, Ford. So think of it like this. A stock is like a piece of a pie. Think of a pizza. Basically, each slice is now one single share of that company. If you own a slice, you own part of the business. So how do you make money from the stocks? There are two main ways: price growth and dividends. Price growth, also called capital gains. If the company does well, more people want the stock, prices go up, you buy at 100, sell at 150, $50 profit. Dividends, these are cash payments. Some companies pay you part of their profits regularly. It's like getting paid just for owning the stock. So why do they exist in the first place? Well, basically they exist because companies sell stocks to raise money, get investors, share in growth and profits. But here's the reality of it, though, because there's always a catch. Stocks are not guaranteed. Prices go up and down daily. Companies can fail, and you can lose money. So some key terms. Just understand that share is one unit of ownership. And what the stock market is where the stocks are being bought and sold. Think of the New York Stock Exchange. And portfolio, that is a term for your collection of stocks. So bottom line is, guys, is that stock is ownership, and it gives you risk and opportunity. You're betting that the business will grow over time. And if it does, you benefit. What is market cap? Simple formula. Market cap is the stock price times by number of shares. Example, as I've illustrated here, you have a company that has 1 million shares. Each share is about $100. Simple math, 1 million times by 100 gives you $100 million. Here's an example. If you look at a company like Apple, share prices change daily. Multiply that by the billions of shares they have, you get a market cap in the trillions. So why does market cap matter? Well, market cap matters because it tells you the size and risk level of the company. Large cap, these are over 10 billion. These are your heavy hitters, guys. This is your Microsoft, your Amazons, your Ford, your General Motors. Mid cap, it's 2 to 10 billion. This is a balanced growth plus moderate risk. At small cap, less than 2 billion. These have high growth potential, but also high risk of volatility. Here's a little insight for you all too. Market cap does not equal how expensive a stock is. A $1,000 stock can be smaller than a $50 stock. What matters is total company value, not the share price. So bottom line here, guys, is market cap is what the market thinks the company is worth right now. It helps you quickly answer, is the company big or small? Is it likely stable or risky? So what kind of stocks are there? Well, there's two main kinds. There's common stock and preferred stock. And you see the chart over there, guys. Well, I've listed for you what they are, but just to give you a quick rundown, common stock, this is what mostly people buy. This is what you get from trading platforms like on Robinhood, E-Train, Charles Schwab, Fidelity, all that stuff. You get ownership in the company. You get voting rights, potential price growth, and sometimes you get dividends. Preferred stock. Think of this as a hybrid between stocks and bonds. Basically, what you get is a fixed dividend. It's more stable income, but there's no voting rights. It's less growth, but more predictable cash flow. And they get paid out first before common stocks. So usually it works as you get paid bonds first, then the preferred stock, then common stock. So you have classifications of stocks. You have growth stocks. These are companies focusing on expanding faster rather than paying dividends. They have high potential returns, high risk, profits are reinvested. Examples, Amazon in the early years. Value stocks. These stocks look undervalued compared to the actual worth. Some of their characteristics is that they can be more stable, they're slower growing, often cheaper than they should be. Investors are looking for a bargain here. Dividend stocks. Companies that regularly pay cash to shareholders. These are steady incomes, usually established companies, lower growth than tech. Think of your Coca-Colas and your Ford Motors. And then you got your blue chip stocks. These are large, well-established, financially strong companies. They're reliable, low risk, long track record. Again, Microsoft, Ford, these are the heavy hitters. So as like I said before, classifications, you got small cap, mid cap, large cap. These are based on company sizes. Basically, some simple way to think about this, guys, is for income growth, you want dividends or preferred. You want safety, you stick to the blue chips. You want deals, value stocks. And if you want growth, growth stocks. Bottom line, stocks aren't all the same. They are tools for different strategies, such as growth, income, speculation, and stability. So you got different types of market sectors. So what's a stock market sector? Basically, there are different types of sectors that each of the stocks are categorized into. So one would be technology. These are computer-focused software. Think of your Apples and your Microsoft. These have high growth potential, but they can be volatile. Healthcare. Think of medical, biopharm. This is your Johnson & Johnson, your Pfizer's. These are stable and recession resistant, big upside with biotech. Financials. These are your banks, your insurance companies, JP Morgan, Goldman Sachs. This is basically interest rates, and basically they're pretty cyclical, and they rise and fall with the economy. Another is consumer. Think of wants like Amazon, consumer staples. These are needs. Think of Procter & Gamble. Energy. This is big. These are oil, gas. These are tied to oil prices. Also good for dividend-paying stocks. Again, you have industrials. These are more of the manufacturing. Think of Boeing, Ford, communication, telecom, Meta, Verizon, T-Mobile, real estate REITs. So these are income producing. These are property owning type stocks. These have high dividends also, but they can also be sensitive to interest rates. Materials, raw materials, chemicals, Dow Chemical, utilities, electrical power. Think NextEra Energy, very stable. Again, very good dividends. So I list out for you a simple strategy. So if you're growth focused, you want to look at tech, consumer discretionary, stable. Look at utilities, healthcare, economics with cyclical. Look at financials, industrials, inflation hedges, energy, and real estate. So as we talked about earlier, there's types of risk. So what type of risk do you want to watch for? Well, there's market risk, which is systemic risk. The entire market drops. Everything goes down. Basically, this is caused by a recession, wars, rate hikes. Even strong companies like Apple and Microsoft, they do have sensitivity to this. And you cannot avoid this. You can only manage it. company-specific risk. This is unsystemic risk. Something goes bad within the company, bad management, lawsuits for earnings. You can reduce this by owning multiple stocks. And you also have liquidity risk. You can easily sell your stock at a fair price. Happens in small or low volume stock. Now, continuing with the type of risk, volatile risk, prices, they go up and down. Inflation risk, like I said before, inflation is 5%, you own 4%, you just lost your purchasing power. Interest rate risk. When interest rates go up and down, stocks often dip. Usually, these are more towards your small cap stocks where this affects the most, but it does tend to hit all stocks. Economic risk, again, that's another thing. Political risk, that's a big one, guys. When new laws get passed, taxes, that's another thing you got to consider as a big time is taxes. Currency risk, too. This is more for international investing if you invest outside the United States, but pretty much anywhere in the world, any type of currency carries risk, especially if you're in third world countries. Think of Eastern Europe, South America. These type of areas, though, they have very risky currencies. So some pros and cons here, guys. Basically simple is that pros is that you get a high return potential, you have some control, there are lower fees, and if you stick with it long enough, you can avoid the bear market. But cons, again, higher risk. And if you don't diversify, you're in trouble too also. Timing's also important, and you have to watch emotion too when you get involved in the stock markets. You don't want to get that FOMO or anything happening to you. And it's hard to consistently win in the stock market. I mean, I've been investing in the stocks for over 20 years, and I've won and I've lost. And the most important thing is to learn from where you lose, so that way you minimize that risk. So there's a comparison chart for you guys. So bottom line is that individual stocks, you get high risk, but there's also high rewards. Funds, ETFs, those are lower risk, they get steady growth. So a real world strategy, you want 79% diversified funds, 10 to 30% individual stocks. Now here's a big thing I want to talk to you guys about. Taxes, specifically in the United States. Capital gains tax. This is when you sell. Short term, this is less than a year. This is taxed at your ordinary income. It can be as high as 37%. This is the worst case scenario. Long term, this is greater than a year. Usually the rates are 0, 15, and 20%. Most earners fall between 50 and 20%. This is a much better tax treatment. This is what I always say, guys. Investing in the stock market is a long term. You have to at least stay in it 5 years or longer to make any kind of significant return. Dividend stocks. There's two types. There's qualified and ordinary. Qualified, this is taxed in your long term, like 0 to 20%. Ordinary dividends, this tax is like regular income. This can go up to 37%. Net investment income tax, that's for the extra high earners. And state taxes, here in Illinois, we have a flat 4.95%. Look at your specific state for that for details. And there are also fees with the stock. So not everything is free, guys. However, trading platforms like Robinhood, Fidelity, those fees were mostly gone. I noticed when I first started trading, tradings for stocks were about $20. Then they went down to 15. Then they went down to 7, and now they're pretty much free. You also have management fees. This is for ETFs, mutual funds. You have advisor fees if you use an advisor. If you borrow against your equities, there is interest that's charged at your broker. Some brokers charge between 6 and 12%. You're looking at an average about 10% for that. Also, I want to make key takeaways here, guys. You want to minimize your taxes. Like I said, hold them for longer than a year. Use tax loss harvesting, retirement accounts. You want to be strategic. And there I give a real-world example of how when you make a $200,000 profit. Now, this is held for longer than a year. So you're looking at 20% capital gains of $40,000 and net investment income tax of 3.8%. And if you live in a state, here it's 4.95%. That's $9,000. So your total tax is $57,000, around 28 to 29%. So now you're asking yourself, well, where do you want to put your money? Well, there's different kind of accounts. You can do a regular taxable brokerage account. This is for long-term holds. These are for growth stocks. You hold long-term, you get 15-20% tax rate as opposed to 37. Most people do is a retirement account, IRAs, Roth account, some excellent tax strategies. Again, hold for more than a year, tax loss harvesting, offset gains with losses. And you can also use business strategies with this also. So an ideal allocation, usually for high income strategies, 60 to 80% index funds, 10 to 20% you want individual stocks, another 10 to 20% in real estate. If you want more of an advanced move, you can combine real estate and stocks. But one of the mistakes that you want to avoid is day trading, selling too early, and also ignoring tax planning. So bottom line, if you want to do this, you want to grow your wealth through stocks, use real estate to offset gains. This is how high income earners create real wealth. And so that's about it, guys. So if you like this presentation, please like and subscribe. And as always, have a prosperous day.